If you were buying a coat for someone you didn't know, it wouldn't be enough to know the person's weight. You'd need the height as well. In finance, the same principle applies when evaluating whether an investment is a good fit for your client. Risk and return are the two halves of the whole. The right level of risk depends on the expected return. When the stakes are high, the potential payoff must be big or investors will walk away. For investments, we need to know the stock's average or mean return. In other words, what percent return can the investor expect? We also need to know the firm's risk, measured by variance or standard deviation. Variance tells us by how much returns differ from the average return. Rationally, and we assume investors are rational, you want more return for less risk. One of the ways to have less risk without reducing return is through diversification. Diversification is a powerful concept in finance. It means that portfolio risk can be less than the sum of its parts. In other words, you can take a collection of risky assets and create a portfolio that is less risky than each of the assets in that portfolio. Suppose you play a simple gambling game with your friend. You roll 2 six-sided dice, and if the roll is even, you win, and if it's odd, you lose to your friend. You could play the game once and bet $100 on one roll of the dice, or you could play the game 100 times, betting $1 on each throw. The chance of even or odd is 50%. So with both of these games, you have an expected return of $50. Now, that's the expectation. The actual return for 100 rolls could be slightly higher or slightly lower than $50, but it's going to be close to $50. Since each roll is independent of the prior rolls, you will have a minuscule chance of losing all $100. But if you bet $100 on a single roll, then your expected return is also $50. But risking $100 on one roll is more risky than $1 each on 100 rolls. With the 100 rolls, you are spreading out your risk. The benefits of diversification have been known for centuries. A 1774 document instructs the manager of a Dutch mutual fund to hold an equally weighted portfolio of Russian government bonds, Bank of Vienna bonds, English colonial securities, German government loans, and Spanish canal loans. The idea behind diversification is that even though those English colonial securities tanked in 1776, the portfolio had spread its risk around with the expectation that the other securities in the portfolio would cancel the losses from any single disaster. So, how do you achieve diversification? You must look at both stocks and bonds. For stocks, you want to invest in multiple industries like technology, consumer goods, healthcare. For example, if tech company stocks drop, well, maybe consumer goods stocks will perform exceptionally well. If consumer goods stocks aren't doing well, maybe telecom will soar. And investors should also have fixed income securities like bonds. Other options investors have are real estate, commodities like precious metals, super safe treasury securities, and foreign company and foreign government investments. A portfolio with 80% invested in stocks and 20% in bonds earns 97% of the S&P 500 return and only has 85% of the risk. A portfolio of 20% stocks and 80% bonds provides 110% of the return of an all-bond portfolio with only 95% of the risk. So even a little bit of diversification helps. If you want even more diversification, you can diversify yourself by learning new job skills. And you can diversify your physical capital by buying a vacation home or rental property someplace other than where you live. The key to diversifying is to choose assets that are as little correlated with each other as possible. Positive correlation means moving in the same direction, and negative means moving in the opposite direction. For example, most tech companies are highly correlated with the overall stock market. They do well in expansionary times and poorly in recessions. A collection agency, on the other hand, does well in recessions, lots more business, and poorly in good times when people have less trouble paying their bills. Diversification is easy. You can invest in mutual funds. There are stock funds, bond funds, mixed stock and bond funds called balanced funds, index funds, global funds, country funds. You name an investing goal, and there's probably a fund that has that as its goal. So why would anyone hold a portfolio with a single stock? They wouldn't, or at least they shouldn't. It makes sense to hold different types of assets from different industries and regions, so you don't lose it all if you make a bad bet.